So I want you to imagine for a second that you're a chef.
Okay, I'm a chef.
Right, and you go to the local market. The market dictates that you buy your raw ingredients, let's say chicken and root vegetables, for exactly $5.
Right. My raw input cost?
Exactly. And the prevailing market price for your standard chicken dinner is $15.
So I make $10. It's just strict math.
Right. It's mathematical reality.
Right.
The market allows you to make exactly $10 in profit. But what if I told you there is an enterprise out there that looked at that exact same market math, bought the exact same raw ingredients, sold into the exact same consumer market, and somehow walked away with 114% of that theoretical maximum profit?
I mean, they're walking away with $11.40 when the market says they are only allowed to make 10.
Yes. Exactly. And they aren't doing this with poultry and vegetables, They're doing it with millions of barrels of crude oil.
Oh, wait.
Yeah. So today, our mission is to completely dissect the Q4 2025 earnings call of the Marathon Petroleum Corporation, or MPC. We're opening up the hood on a $12 billion profit engine. This source material, which features their CEO, Marianne Manin, and their new CFO, Maria Currie, is essentially, it's a masterclass in hyper-optimization.
It really is. I mean, the goal here isn't just to read off a bunch of balance sheet numbers. It's to understand the story those numbers are telling about the global economy right now.
Exactly. And you don't need to be a Wall Street analyst to care about this. We're going to explore the physical chemistry of refining, how a pipeline traffic jam in Canada creates windfalls in Louisiana, and why the artificial intelligence boom is secretly banking on century-old fossil fuel extraction.
Yeah, and how a massive corporation basically engineers its cash flow to become nearly invincible to global chaos.
Right. It's wild. So to understand the sheer scale of what they're accomplishing, we have to ground ourselves in their financial reality first.
Definitely. So for the full year of 2025, MPC reported an adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization of a staggering $12 billion.
$12 billion.
Yeah. For the fourth quarter alone, that number was $3.5 billion.
Which is just a massive amount of cash.
It's unbelievable. And a massive portion of that cash generation comes from their core refining and marketing segment.
Yeah.
They posted this incredibly strong margin of $7.15 per barrel in Q4.
Okay, I want to zoom in on that 114% number I mentioned earlier, because in the source material, you could tell the analysts were totally fixated on it.
Oh, absolutely.
In the refining industry, the benchmark for profitability is called the crack spread. Right?
Right.
And if I understand the mechanics correctly, the crack refers to the literal physical process inside the refinery. Like they take these massive hydrocarbon molecules and subject them to intense heat and pressure until the carbon bonds physically snap or crack into smaller, more valuable molecules, like gasoline and diesel.
Yeah, that's exactly it. So the crack spread is the theoretical profit margin a generic, perfectly average refinery should make. The standard benchmark is called the 3-2-1 crack spread. It assumes you buy 3 barrels of raw crude oil, you run it through a standard distillation and cracking process, and you produce roughly 2 barrels of gasoline and 1 barrel of diesel.
So 3 in, 3 out.
Right. You subtract the cost of the crude from the market price of those refined products, and that leaves you with your benchmark margin. If you capture 100% of that margin, you performed exactly as the theoretical math dictated you should.
But capturing 114% like MPC did in Q4 means they took that theoretical maximum the market offered and just shattered it.
Completely.
It goes back to our chef analogy. Capturing over 100% means the chef isn't just selling the chicken dinner. They're taking the vegetable scraps and the chicken bones, boiling them in a pressure cooker, and selling a premium artisan broth on the side.
Yeah, or they're using their sheer scale to negotiate some secret backdoor discount on the raw chicken in the first place.
Exactly. They're swapping out expensive side dishes for cheaper ones the second the commodity price shifts. They are extracting phantom value out of the exact same raw materials.
And the executives on the call attributed this massive outperformance directly to their commercial team. The commercial lead, Rick, explicitly stated that their mandate every single day is to, quote, expand the crack.
Expand the crack.
Right. They are constantly looking for microscopic arbitrages in the market. One example he highlighted for Q4 was seasonal butane blending, which, it sounds like a footnote.
It sounds super boring.
Right. But it actually drives hundreds of millions of dollars in excess value.
So I actually went down a massive rabbit hole on the chemistry of butane blending after reading the transcript because it perfectly illustrates how they manufacture this extra margin out of thin air.
Oh, it's fascinating.
Yeah. So gasoline isn't one single liquid, right?
Yeah.
It's a volatile cocktail of hundreds of different hydrocarbons. And the recipe for that cocktail is legally mandated to change depending on the season, based on something called Reid vapor pressure, or RVP.
Right, which measures how easily a liquid vaporizes into a gas.
Exactly. So in the dead of winter, when the ambient air temperature is freezing, a car engine needs a gasoline blend that vaporizes very easily. If the liquid doesn't vaporize inside the cold cylinder, the spark plug has nothing to ignite.
And the car won't start.
The car won't start. So the winter regulations allow for a much higher vapor pressure. And butane, which is this highly volatile 4-carbon chain molecule, has a massive vapor pressure.
And it's also incredibly cheap.
Dirt cheap because it's a plentiful byproduct of both refining and natural gas processing.
Right.
But in the summer heat, if you put too much butane in gasoline, it vaporizes inside the fuel lines before it even reaches the engine. It causes vapor lock. And the EPA strictly outlaws it to prevent smog. But in the winter, those regulatory constraints loosen up.
And this is where MPC's commercial and supply chain teams coordinate this massive logistical ballet. They buy up this cheap butane in bulk, transport it to their blending facilities, and precisely inject it into the higher value winter gasoline pool.
Right up to the absolute legal and physical limit.
Exactly. They're essentially diluting the expensive premium gasoline molecules with dirt cheap butane molecules, creating a finished product that works perfectly in a cold engine and meets all the regulatory specs.
Wow.
Yeah, every gallon of butane they blend into that pool is bought at a steep discount and sold at the premium gasoline price.
So they are literally manufacturing profit out of a temperature change.
Basically, yeah.
But, I mean, to pull off those microscopic, high-wire commercial trades, your actual steel and pipe factories have to be running flawlessly.
Oh, absolutely. If you are constantly shutting down units because a pump failed or a pipe leaked, you can't blend the butane or capture the margin.
Right, you're offline.
Yeah. And the numbers here are wild. They reported a 95% utilization rate across their entire refining system for the fourth quarter.
95%?
Yeah, they pushed their Garyville and Robinson refineries to all-time monthly crude throughput records.
So the operational reliability is really the foundation of the whole commercial strategy.
You cannot trade barrels you failed to produce. And this reliability isn't just about, avoiding downtime. It ties directly into their process safety metrics.
Okay.
The CEO noted this was their strongest company-wide process safety performance in 4 years, and the lowest environmental incident rate this decade.
Wow, so they're running it hard, but safely.
Right. When your safety metrics are that strong, it means your pressure valves, your distillation columns, your hydrotreaters, they're all operating exactly within their engineered parameters. The system is perfectly stable, which allows the commercial traders to push it right to the edge of maximum profitability.
And what happens when a $12 billion engine runs flawlessly like that? It generates just an ocean of free cash flow.
A literal ocean.
Yeah. In 2025 alone, MPC returned $4.5 billion directly to their shareholders through dividends and share repurchases.
$4.5 billion.
Right. By aggressively buying back their own stock, they managed to shrink their outstanding share count by 6.5% in just 12 months.
That's huge.
It is. If you own a piece of this company, your piece just became mathematically larger, driving up the earnings per share for every single investor who simply held onto their stock.
And Marianne Manin made it abundantly clear on the call that this isn't some one-off event. Assuming market conditions hold, their baseline corporate policy is to return all excess free cash flow to the shareholders.
So the cash just keeps flowing, but to generate that cash, we have to look at the other side of the equation. We talked about how they sell the product, through butane blending and all that, but the real magic happens in how they buy the raw ingredients.
Right, the sourcing strategy.
Yeah, this requires us to dive into the physical reality of crude oil itself. Mm-hmm. On the call, the executives revealed a statistic that, honestly, it completely recontextualizes their structural advantage.
Which one was that?
Nearly 50% of MPC's total crude diet is, quote, sour crude. And the CEO pointed out that this sour processing capability is roughly 10% stronger than their closest competitor.
Right.
Now, for the casual listener, sour crude might sound like a minor geological distinction, but it is actually the bedrock of their entire financial moat.
It really is. Because crude oil is not just one uniform substance, right? It varies wildly depending on which subterranean rock formation it was pumped out of. It's graded primarily on two factors.
Density and sulfur.
Exactly. Density, which is measured by API gravity as light or heavy, and sulfur content, which is graded as sweet or sour.
Okay, so sweet crude, like West Texas Intermediate.
Right. Sweet crude has very low sulfur. It's fluid, it's clean, and it requires relatively simple distillation to turn into premium gasoline and diesel.
So because it's so easy to refine, everyone wants it, which makes it the most expensive crude on the market.
Exactly. It's the prime cut of steak.
I love that. The prime cut. Okay, so what is heavy sour crude then?
Heavy sour crude is the toughest, most undesirable cut of meat imaginable. It is thick, highly viscous, and loaded with massive amounts of sulfur, heavy metals, and long, dense carbon chains. Yeah. If a simple, basic refinery tries to process a heavy sour barrel, it's a disaster. The sulfur physically poisons the expensive platinum and palladium catalysts used in the refining units.
Oh, wow. It actually ruins the equipment.
It ruins the chemistry. And on top of that, environmental regulations strictly prohibit burning high sulfur fuels because it creates sulfur dioxide, which leads to acid rain.
Right, of course.
So a simple refinery processing heavy crude will just end up with a massive pile of low-value, unusable sludge or asphalt.
Okay, so because it's so incredibly difficult to process, the global market prices this ugly, heavy, sour crude at a massive discount compared to the sweet stuff.
Exactly. And the difference in price is called the differential.
The differential. And this is MPC's playground, isn't it?
Oh, absolutely. Over the past few decades, they have deployed billions of dollars in capital to upgrade their massive facilities, like the Garyville refinery in Louisiana, turning them into highly complex refineries. They built massive specialized units specifically designed to chew through this cheap, ugly crude.
Yeah, I was reading about the specific hardware they use for this, like hydrotreaters and delayed cokers.
Yeah.
The engineering is terrifying, honestly.
It is extreme chemistry.
Yeah. A hydrotreater takes this high sulfur sludge, injects it with pure hydrogen gas, and subjects it to pressures exceeding 1,000 pounds per square inch at temperatures over 700 degrees Fahrenheit.
Right.
Under those extreme conditions, the hydrogen forces the carbon-sulfur bonds to physically snap, binding with the sulfur to create hydrogen sulfide gas, which is then stripped out and processed into solid elemental sulfur.
It is violent extreme chemistry. And then the delayed cokers take the heaviest, sludgiest leftovers at the very bottom of the barrel, the stuff nothing else can break down, and heat them in massive drums to over 900 degrees.
900 degrees.
Until the giant carbon molecules literally crack apart into lighter, valuable vapors, leaving behind solid petroleum coke. The metallurgy required to build pipes and vessels that can withstand that level of heat, pressure, and corrosiveness without bursting is astronomically expensive.
But once you have that billion-dollar hardware in place, it acts like a money printer.
Exactly.
You buy the heavy sour crude at a massive discount, run it through these extreme units, strip out the impurities, and you end up selling the exact same pristine premium gasoline and diesel that a simple refinery makes from the expensive sweet crude. You pocket the massive differential as pure margin.
And in the source material, they quantified this advantage. A mere $1 widening of the sour differential, meaning the ugly crude, gets just $1 cheaper compared to the sweet crude, translates to a $500 million annual benefit for MPC.
$500 million just from a $1 shift.
$500 million of pure profit dropping straight to the bottom line, simply because the raw material got a tiny bit cheaper relative to the benchmark. This is why the commercial team watches the geopolitical landscape so obsessively.
Right, they're looking for global chaos to widen that differential.
Exactly, and they're currently riding two massive structural macroeconomic waves that are widening those differentials right now.
Okay, let's get into those. The first one is happening in Venezuela, right?
Yes. An analyst from UBS pointed out on the call that the U.S. government has eased some sanctions, and Venezuelan crude, trading under the ticker VENS, is starting to flow back into the U.S. Gulf Coast.
And Venezuelan crude from the Orinoco Belt is notorious. It's extra heavy and incredibly sour. I read it's practically tar.
It is. So as these massive tankers of Venezuelan heavy crude start unloading on the Gulf Coast, it creates an influx of new, highly undesirable supply.
Basic supply and demand.
Right. When you flood a localized market with a specific type of commodity, the price drops. This influx is putting tremendous downward pressure on the price of all heavy, sour crude in the Gulf Coast region.
But wait, I have to challenge this logic a bit. I mean, I'm looking at this from a geopolitical risk perspective.
Okay.
Venezuela is structurally unstable. If I'm an investor, I am terrified of MPC building a $12 billion profit engine that relies on oil from a regime where sanctions could snap back on overnight. Like, aren't they exposing themselves to a catastrophic supply shock?
It's a completely valid concern, and it's a critical vulnerability to probe. But the commercial lead, Rick, addressed this exact scenario on the call.
What'd he say?
He stated unequivocally that MPC will not be the largest buyer of Venezuelan crude. The genius of their strategy is that they don't actually need to buy the Venezuelan oil to profit from its existence.
Wait, how does a company profit from a discount on a product they aren't even buying? If the Venezuelan oil is causing the price drop, wouldn't they have to purchase it to capture the margin?
This is where the sheer scale of their logistics network comes into play.
Yeah.
MPC has the marine terminals, the pipeline connections, and the complex refinery hardware to process over 100 different distinct grades of crude oil.
100 different grades.
They have a massive menu. They can buy Western Canadian Select, they could buy Assisi from the Deepwater Gulf of Mexico, they could buy Alaska North Slope, or Maya crude from Mexico. When Venezuelan barrels hit the Gulf Coast, the buyers who are set up to run heavy crudes start buying it because it's cheap. This means they stop buying the Mexican Maya or the deepwater ACI crude they normally purchase.
Oh, I see where this is going.
Right. Suddenly, the producers of Maya and ACI have stranded barrels with no buyers to move their oil. Those producers are forced to slash their prices to compete with the Venezuelan influx.
Ah, so the Venezuelan oil acts as a localized gravitational pull. It drags down the price of the entire basket of heavy sour crudes across the global spot market.
Exactly. It's a domino effect of discounts.
A domino effect. That makes so much sense.
So MPC can sit back, look at their trading screens, and buy the Mexican Maya or the domestic ACI crude that has been structurally discounted by the presence of the Venezuelan barrels.
Right. They get the wider margin without taking on the geopolitical risk of relying on a single volatile state actor.
Exactly. Though Rick did mention they opportunistically bought 2 cargoes of Venezuelan crude simply because, on a Friday afternoon, those specific barrels were the most economically advantaged offer on the screen. It is pure agility.
They are completely agnostic to the source. They only care about the chemistry and the price.
Completely agnostic.
And that same opportunism is playing out right now on their northern border with Canadian oil, right? Driven by an entirely different kind of disruption. A physical pipeline bottleneck.
Yeah, the analyst from Bank of America brought up the situation with the Enbridge mainline pipeline and a mechanism known as apportionment.
Apportionment. Let's break that down.
So Alberta, Canada, is one of the largest producers of heavy crude in the world, primarily from the oil sands. That heavy bitumen is extracted, blended with a lighter diluent so it can actually flow as a liquid, and then pumped south into the U.S. Midwest and Gulf Coast refineries via massive pipeline networks like the Enbridge mainline.
But pipelines are physical steel tubes. They have a maximum flow rate.
Right. When Canadian production surges, the producers nominate, which means they officially request to ship more barrels than the pipeline can physically accommodate.
Okay.
Let's say producers nominate 100,000 barrels, but the pipe can only handle 80,000. The pipeline operator enacts apportionment, meaning they physically ration the space. Every producer gets a pro rata cut.
So 20,000 barrels of heavy crude are suddenly denied entry to the pipeline. What happens to that oil? It doesn't just disappear.
No, it gets diverted into massive storage tanks in Alberta. But storage isn't infinite, and it costs money. Very quickly, millions of barrels of heavy crude become landlocked and physically stranded in Canada.
The producers are still pumping oil out of the ground, the tanks are filling up, and they have no cheap way to export it.
Panic sets in. To incentivize buyers to take the oil via much more expensive logistical routes like loading it onto rail cars, which costs significantly more than a pipeline, the Canadian producers have to slash the outright price of their oil.
This causes the price benchmark for Western Canadian Select, or WCS, to plummet. The discount against standard sweet crude violently widens.
And who do you think is sitting right at the end of those Canadian pipeline networks in the U.S. Midwest, operating massive, complex refineries equipped with cokers and hydrotreaters, just waiting to chew up heavily discounted landlocked Canadian sludge.
Marathon Petroleum.
Marathon Petroleum.
Their mid-continent refining system is perfectly positioned to absorb the shockwaves of a Canadian traffic jam.
Yeah.
It is fascinating how they capitalize on macroeconomic distress.
Right.
A pipeline backs up in Alberta, a geopolitical shift occurs in Caracas, and MPC's commercial team translates both events into a higher margin capture in Ohio and Louisiana.
But the global crude market is only half of the equation. As sophisticated as their sourcing strategy is, their dominance is equally driven by localized structural shifts in product demand. And this brings us to an entirely different battlefield.
Yeah.
The West Coast of the United States.
The situation in California is perhaps the most striking example of their market positioning. If the Gulf Coast is a story about playing the global supply chessboard, the West Coast is a story about thriving in a highly regulated walled garden where all the other plants are suffocating.
Walled garden is the perfect analogy for the California refining market. The state operates as an isolated energy island. You cannot simply refine standard gasoline in Texas and pipe it to Los Angeles.
Why not?
California has uniquely stringent environmental regulations mandated by the California Air Resources Board, or CARB. They require a highly specific, complex chemical formulation of gasoline designed to reduce smog and particulate emissions.
Right, and on top of the chemical requirements, the regulatory environment is incredibly hostile to the fossil fuel industry. You have the low carbon fuel standard, cap and trade carbon taxes, and explicit state mandates pushing for the rapid phase out of internal combustion engines in favor of electric vehicles.
Exactly.
The regulatory soil in this walled garden has become intentionally toxic for refineries.
Which is exactly why the executives on the call spent so much time discussing the imminent closure of a major competitor's refinery in California, expected to shut down permanently in the spring of 2026.
Right, because for many operators, their facilities are aging, and the capital expenditure required to upgrade them to comply with ever-tightening California regulations simply destroys the internal rate of return. It makes more economic sense for them to simply shutter the plant, dismantle the steel, and walk away.
But here's the critical disconnect that creates the windfall for MPC. The competitor's refinery shuts down, the supply of liquid fuel instantly vanishes, but the people living in Los Angeles still have to commute to work tomorrow morning.
Right. The transition to a fully electric vehicle fleet takes decades of fleet turnover. In the short term, the underlying demand for liquid transportation fuels remains remarkably stubborn.
And the commercial lead observed that the California market was already, quote, short one refinery, meaning organic demand already exceeded local production capacity, requiring expensive imports via ship to balance the market.
Okay, so with this upcoming closure, the market is suddenly short several refineries. It's like playing a game of musical chairs, but instead of the players being eliminated, the chairs are being removed, and MPC owns the biggest chair left in the room.
That's a great way to put it. The plants are dying, but the demand for water remains. And MPC owns the Los Angeles refinery, the LAR, which is not dying. In fact, they're pouring fertilizer on it.
While competitors are fleeing the market, MPC is executing surgical, high-return capital upgrades at the LAR. During the fourth quarter, they completed a major turnaround project. They installed a massive new inertie system that physically connects the Wilmington and Carson sides of the refinery.
Right, and this allows them to optimize their steam and electrical energy usage, feeding both sides from a centralized cogeneration plant. They retired 6 aging, inefficient boilers and brought 2 state-of-the-art boilers online.
They are lowering their internal operating costs and increasing their reliability in a market where they are about to be one of the last remaining suppliers. When supply violently contracts and demand remains inelastic, pricing power shifts entirely to the survivor.
And MPC has a logistical trump card here. They don't just operate in Southern California. They have a massive refining footprint in the Pacific Northwest as well.
Oh, right.
If this upcoming refinery closure causes a severe supply shock and a massive price spike in the San Francisco Bay Area or Los Angeles, MPC has the maritime shipping logistics to seamlessly redirect product down the coast from their Pacific Northwest assets. They can capture the inflated margins that result from their competitors' exit.
The walled garden is brutal, but if you are the last plant standing, you drink all the water. But you know, the most revealing detail about the West Coast strategy wasn't actually about CARB gasoline for cars. It was about airplanes.
Yes. The macroeconomic trends in liquid fuels are bifurcating right now. While the global demand for gasoline and standard distillates like diesel grew by a very sluggish 1% over the past year, the demand for jet fuel surged by nearly 4%.
4%.
The post-pandemic rebound in commercial aviation, coupled with expanding global trade routes, is driving a massive thirst for jet fuel.
And the Los Angeles refinery happens to be the largest single jet fuel producer within MPC's entire nationwide network. They are sitting right next to LAX, one of the top 3 aviation demand hubs in the United States.
Which requires us to understand how a refinery actually pivots between products.
Let's get into that. How do they do it?
Inside the massive atmospheric distillation columns, crude oil is boiled. As the vapors rise up the column, they cool and condense at different physical heights or trays based on their specific boiling points. These are called cuts.
Cuts, got it.
Jet fuel, which is essentially a highly purified form of kerosene, boils between 300 and 480 degrees Fahrenheit. Diesel fuel boils slightly hotter, between 400 and 650 degrees.
So they are physical neighbors inside the distillation tower. The cut points overlap.
Because of that overlap, a complex refinery has a degree of operational flexibility. By manipulating the heat, the pressure, and the specific catalyst downstream, the refinery engineers can literally turn the dials to adjust the yield.
Okay, so they can say, let's make less diesel and more jet fuel today?
Exactly. They can sacrifice a few percentage points of diesel production to squeeze out a few more percentage points of jet fuel, or vice versa, depending entirely on which product commands a higher price in the spot market.
The executives referred to this price differential as the diesel to jet spread. In the third quarter of the year, that spread was a headwind on the West Coast. Diesel was more valuable, so producing jet fuel was less economically attractive. But in the fourth quarter, the spread violently flipped into a massive tailwind. The price of jet fuel skyrocketed relative to diesel.
And because the LAR is highly optimized, the engineers turned the dials, maximize the jet fuel cut, and capture the premium.
And they aren't just selling this jet fuel to commercial airlines like Delta or United either. The commercial lead made a very specific point to highlight significant, sustained demand signals coming from the Department of Energy and the Department of Defense.
The U.S. military.
The Department of Defense is one of the largest single institutional consumers of liquid hydrocarbon fuels on the planet.
Easily. To maintain global readiness, conduct training operations, and secure logistics supply chains amid rising geopolitical tensions, the military requires a massive, unassailable domestic supply of jet fuel.
An MPC, because of its sheer scale and demonstrated operational reliability, serves as a critical supplier to the government. This establishes a baseline of secure, high-volume demand that completely insulates them from the typical consumer-driven boom and bust cycles.
Think about the convergence of variables here. A local environmental regulation forces a competitor to shut down a refinery in California, just as global commercial air travel surges by 4%, right when the U.S. military ramps up procurement.
And all of these disparate macroeconomic forces flow directly into a massive margin capture at this single facility in Los Angeles.
It is a stunning display of strategic positioning. However, we have to address the glaring vulnerability in this entire business model.
The commodity cycle.
Exactly. Everything we have discussed so far, the sour crude differentials, the butane blending, the diesel to jet spreads, these are all commodity margins. They are inherently cyclical.
Right. If a severe global recession hits tomorrow, commercial air travel plummets, shipping grinds to a halt, and everyday consumers stop driving. The crack spread collapses. That 114% margin capture doesn't mean anything if the underlying benchmark margin drops to zero.
Exactly.
So how does a $12 billion enterprise prevent itself from instantly collapsing when the volatile commodity cycle inevitably busts?
They survive because of a hidden safety net structured deep within the corporation. The secret to Marathon Petroleum's financial invincibility isn't actually their refineries.
It's not the refinery.
Nope. It is their midstream logistics segment, operating under the ticker MPLX.
Okay, I noticed they refer to MPLX as a master limited partnership, or an MLP. What exactly is a midstream MLP, and why is it so crucial to insulating MPC from the chaos of the crude market?
To understand the midstream, we have to look at the 3 pillars of the energy industry. Upstream is the exploration and production sector, the companies drilling the holes in the earth and fracking the shale rock to extract the raw hydrocarbons.
Right, the drillers.
Downstream is the refining and marketing sector companies, like MPC, that chemically alter the molecules and sell them to end users. Midstream is the massive, sprawling nervous system that connects the two.
The nervous system.
It consists of thousands of miles of pipelines, massive tank farms, export terminals, and natural gas processing plants that physically move the molecules across the continent.
So MPLX is the logistics and transportation arm. But why is it structured as a master limited partnership instead of just a regular corporate division inside MPC?
The MLP structure is a unique financial vehicle created by the U.S. tax code specifically to encourage infrastructure investment. An MLP does not pay corporate income tax.
Wait, no corporate income tax?
None. Instead, all the income generated by the pipeline assets passes through directly to the unitholders, the investors, in the form of quarterly cash distributions. To maintain this tax advantage status, the MLP is legally restricted. It must derive nearly all of its income from the physical processing, transportation, or storage of natural resources.
And the way they generate that income is fundamentally different from a refinery. They aren't trading crack spreads or worrying about the price of a barrel of oil.
Not at all. MPLX operates on a pure fee-based business model. It is effectively a continent-spanning toll road for hydrocarbons.
A toll road.
Right. MPLX doesn't actually own the crude oil or the natural gas that flows through its steel pipes. They simply sign long-term, multi-year contracts with the upstream drillers and the downstream refiners, including their parent company, MPC. The contract stipulates a fixed volumetric fee. For every single barrel of oil or 1,000 cubic feet of natural gas that physically passes through the pipe, MPLX collects a toll.
So they are completely agnostic to the commodity price. Whether crude oil is trading at $120 a barrel during a geopolitical crisis or negative $30 a barrel during a pandemic lockdown, MPLX collects the exact same toll fee as long as the molecule moves.
It is an incredibly stable, predictable, recurring revenue stream. And the sheer volume of molecules they are moving is staggering.
How staggering.
In 2025, MPLX generated nearly $7 billion in adjusted EBITDA. The CEO highlighted a statistic on the call that shows their absolute dominance. MPLX infrastructure physically handles 10% of all the natural gas produced in the entire United States.
10% of the nation's gas supply flows through their toll booths.
Yeah.
Wow. This gives them unparalleled visibility into the macro trends of the domestic energy grid, which makes their next move incredibly fascinating. MPLX is not resting on its laurels. They announced a massive $2.4 billion growth capital investment plan for 2026.
And they aren't spending that money on crude oil pipelines. 90% of that growth capital is being directed specifically toward natural gas and natural gas liquids infrastructure in the Permian and Marcellus shale basins.
This represents a massive strategic pivot. The source material notes that U.S. domestic natural gas demand is anticipated to surge by over 15% between now and 2030.
They cited the continued build-out of liquefied natural gas, or LNG, export terminals on the Gulf Coast. But they also explicitly cited a totally new, massive driver of demand, the rising power needs from data centers.
Artificial intelligence, this is where the narrative takes a wild turn. We constantly hear about the energy transition. We hear that the future is solar, wind, and the rapid phase out of fossil fuels. But here we have an executive at a legacy petroleum company betting billions of dollars on the premise that the most advanced digital technology in human history, the AI revolution, is actually going to trigger a massive secondary boom in natural gas consumption.
It's totally counter-narrative.
How exactly is a chatbot driving pipeline expansion?
We have to confront the physical reality of the digital cloud. Large language models and generative AI are not ethereal concepts. They're rooted in massive hyperscale data centers packed with thousands of high-density servers. The computational power required to train and run these models consumes an astronomical amount of electricity, both for the processors themselves and for the massive HVAC systems required to keep the servers from melting down.
These data centers run 24 hours a day, 7 days a week, 365 days a year.
And that continuous operation requires absolute, unyielding power grid stability, known as baseload power.
Oh.
While renewable energy sources like wind and solar are expanding rapidly, they suffer from intermittency. The wind stops blowing and the sun sets.
And battery storage technology is simply not advanced or cheap enough yet to bridge multi-day gaps in renewable generation at a gigawatt scale.
Exactly. When a tech giant builds a massive new AI data center, the local utility company is instantly saddled with a massive continuous power load. To guarantee that power won't fail when the sun goes down, the utility must build dispatchable generation power plants that can be turned on and ramped up at a moment's notice.
Nuclear power takes a decade to permit and build. Coal is politically dead and environmentally toxic.
Leaving natural gas combined cycle power plants as the only viable option. They can be built relatively quickly, they run incredibly efficiently, and a gas turbine can spin up from zero to full power in a matter of minutes to balance the grid when a cloud covers a solar farm. The tech boom is inextricably tethered to the natural gas grid.
And MPLX is aggressively positioning itself to be the toll collector for that massive surge in demand. But the CEO also highlighted a fascinating geological phenomenon driving the supply side of this equation. She mentioned that they are seeing higher gas-to-oil ratios across key shale basins as aging wells produce more associated gas.
Right.
I looked into the geology of this because it sounds incredibly counterintuitive. When an upstream company drills a well in a basin like the Permian in West Texas, they are primarily targeting liquid crude oil because oil is far more lucrative than gas.
But natural gas is almost always trapped inside the microscopic pores of the shale rock alongside the oil.
This is what is known as associated gas. When a shale well is initially hydraulically fractured and completed, the intense reservoir pressure forces a massive surge of liquid crude oil to the surface, along with a moderate amount of gas. But over the months and years, as the well ages, the physics of the subterranean reservoir change.
The pressure drops.
Exactly. As the reservoir pressure drops below the physical bubble point of the hydrocarbons, the natural gas begins to expand and release from the liquid oil deep underground. The heavier oil becomes harder to pump out, but the lighter gas surges to the surface.
So as a shale basin matures, the production curve shifts. The oil volumes decline rapidly, but the volume of natural gas coming out of those exact same wells steadily increases.
The gas-to-oil ratio flips. So you have a geological reality where millions of aging wells in Texas are suddenly burping up massive, unanticipated volumes of natural gas. And simultaneously, you have a technological reality where AI data centers are demanding massive, unanticipated volumes of electricity generation.
And MPLX is spending $2.4 billion to build the gathering pipes, the processing plants, and the long-haul pipelines to connect that specific supply to that specific demand. They're capturing the toll on every molecule.
Which brings us to the most brilliant piece of financial engineering in this entire corporate structure. We know MPLX is a massive cash machine. How does that cash actually benefit Marathon Petroleum, the parent company?
Because MPC is the sponsor and the majority unit holder of the MPLX Master Limited Partnership, a massive portion of those tax-advantaged quarterly cash distributions flow straight up the corporate structure into MPC's treasury.
How much cash are we talking about flowing upstream?
The CEO explicitly guided that MPLX is expected to provide over $3.5 billion in future annual cash distributions directly to MPC.
$3.5 billion a year in completely predictable, fee-based toll revenue.
And the CFO, Currie, synthesized exactly what that means for their balance sheet. That $3.5 billion completely covers MPC's baseline corporate obligations. It entirely pays for the parent company's own dividend to its shareholders, and it fully funds MPC's entire capital expenditure budget for the year.
Wait, let that sink in. The boring, unglamorous pipeline subsidiary generates so much stable cash that it pays for all the maintenance, all the upgrades at the refineries, and all the base dividends for the parent company.
The midstream safety net covers the foundation of the house.
Which means that 100% of the cash generated by the highly volatile, highly lucrative refining business, that massive $12 billion EBITDA engine playing the global crude chessboard, all of that is excess free cash flow.
It can be utilized exclusively for massive stock buybacks, completely de-risking their capital return strategy.
It is a self-funding, perpetual motion machine of capital generation. The toll road pays the bills, and the refining casino provides the windfall profits to buy back the stock. And that leads us perfectly into understanding exactly how they are allocating capital for the future, because you would assume a company generating billions in excess cash would be breaking ground on massive new mega refineries across the globe.
But they aren't. They are doing the exact opposite.
We are witnessing a profound structural shift in the philosophy of the energy industry. For the last 50 years, the corporate mandate was growth at all costs. You took your windfall profits and you plowed them into building a massive new $10 billion refinery to increase your overall market share.
But the industry repeatedly burned itself doing that. They would overbuild capacity, flood the market with product, and crash their own refining margins.
They learned the hard way. The CFO announced their 2026 capital expenditure plan for the refining segment is just $700 million. In the context of a $12 billion profit engine, $700 million is incredibly small.
It is.
But more significantly, the CEO highlighted that this represents a 20% reduction in spending compared to 2025, and they are telegraphing further reductions in 2027 and 2028.
This is the era of strict, unyielding capital discipline. The goal is no longer to build new capacity. The goal is hyper-efficiency. The engineering mandate is, how do we spend significantly less money but extract more high-value yield from the steel and pipes we already have in the ground?
It's precision engineering over brute force. Instead of building a new facility, they deploy capital surgically to debottleneck specific constraints inside existing plants.
The source material outlines 3 highly targeted projects for 2026. Look at the 2 projects slated for the Garyville refinery.
Okay, let's look at those.
The first is a $110 million investment designed to optimize the crude feedstock slate. The engineers identified a specific thermal or hydraulic bottleneck at the front end of the distillation process.
Right.
By spending a relatively small amount of capital to upgrade a heat exchanger network or a pumping system, they are unlocking the ability to push an additional 30,000 barrels per day of raw crude through the unit,
which allows them to reduce their reliance on buying expensive, partially refined intermediate feedstocks from other companies. They are lowering their input costs.
Exactly. The second Garyville project is even more surgical. A $50 million spend to increase their yield flexibility, specifically allowing them to produce an additional 10,000 barrels per day of export-grade premium gasoline.
And this targets a very specific macro trend. While the domestic U.S. market for standard gasoline is highly saturated and mature, there is massive structural demand growth for high-octane premium fuels in international markets, particularly in Latin America.
Right, so by spending just $50 million on advanced separation or compression equipment, they give their commercial team the physical capability to pivot their production slate and capture that lucrative export premium.
The financial rigor applied to these micro projects is intense. The CEO stated they only put capital to work where it creates immediate tangible value, and they consistently target an internal rate of return, or IRR, of 25% or above.
A 25% IRR is a massively high hurdle rate in the industrial sector. In their midstream pipeline business, they are happy to accept mid-teens returns, maybe 13 to 15%, because it is a guaranteed low-risk toll model backed by long-term contracts.
But in the refining business, the capital is completely exposed to commodity price crashes and the looming existential threat of the energy transition. If a refining project does not guarantee a blisteringly fast payback period and a massive margin expansion, the executives simply reject it. They would rather give the cash back to the shareholders.
This cultural shift toward hyper-efficiency is perfectly embodied in their new CFO, Maria Currie. When Marianne Manin introduced her on the call, she didn't praise her vision for massive expansion. She specifically highlighted Maria's 25-year background in, quote, operational excellence, cost competitiveness, and possessing a, quote, lean mindset.
The appointment of a CFO with a self-described lean mindset is a massive, flashing neon sign to Wall Street analysts. It signals that the entire corporate culture is fully aligned around capital discipline and cost reduction. Every single department, every single capital request is being ruthlessly scrutinized to maximize the cash yield on the existing asset base.
But you know, there is a human element to this hyper-optimized machine. Yeah. You can have the most brilliant commercial team trading butane spreads and the most disciplined CFO managing the capital, but operating these massive, highly volatile physical assets requires an incredibly skilled, specialized workforce.
And that brings us to the critical issue of labor relations discussed on the call.
The source material notes that MPC is currently engaged in complex negotiations with the United Steelworkers, the USW, which is the massive union representing the specialized workforce operating the refineries. The previous labor contract actually expired on January 31st, right in the middle of this earnings cycle.
A labor strike at a facility like Garyville or Los Angeles would be a catastrophic event. You can't capture 114% of the margin if the operators walk off the job, and you have to idle the distillation columns.
It is the ultimate operational vulnerability. But when an analyst pressed them on the deadline and the potential for a work stoppage, the executive leading the negotiations, Mike, outlined a very specific mechanical process they are using to maintain stability. He noted that they are operating under 24-hour rolling extensions.
Let's break down how that mechanic works. When a master contract expires, the two parties can agree to a rolling extension. This means the terms, wages, and safety protocols of the old contract remain fully legally binding day by day, as long as both sides agree they are making productive progress at the bargaining table.
Either the union or the management can terminate the extension, but they were required to give a 24-hour notice before any work stoppage or lockout can occur. Mike explicitly stated that he views this rolling extension as a positive indicator. It means they are actively bargaining in good faith to reach what is called a pattern agreement.
A pattern agreement is essentially a blueprint. The union negotiates a master baseline standard for wages, healthcare benefits, and critical safety protocols with a lead company. Once that pattern is established, all the local union chapters across the entire industry adopt it for their specific facilities.
And the rolling extension ensures that while the lawyers and union leaders debate the economics of the next multi-year agreement, the highly profitable facilities continue to run safely. The golden goose keeps laying eggs.
It is a critical piece of risk mitigation. Open dialogue without a work stoppage allows the commercial teams to confidently execute their forward-looking trades, knowing the physical barrels will actually be produced.
Before we conclude, I want to highlight one final brief detail tucked into the Q&A portion of the call, because it hints at how they view the inevitable energy transition. They discuss the Martinez Renewables joint venture.
The Martinez facility is located in California. It used to be a traditional fossil fuel petroleum refinery, but MPC partnered in a joint venture to completely strip it down and convert the hardware to process biological feedstocks like soybean oil and rendered animal fats into renewable diesel.
They noted that the Martinez facility ran at an impressive 94% utilization rate in the fourth quarter, but they warned the analysts that the utilization would drop to around 70% in the first quarter of 2026 due to a scheduled turnaround.
In the refining industry, a turnaround is a massive, planned maintenance event. You take an entire operating unit offline, depressurize the massive vessels, send crews inside to clean out the coke and sludge, replace degraded catalysts, inspect the metallurgy for microfractures, and upgrade the pumps.
It costs tens of millions of dollars and takes weeks to execute, but it is absolutely non-negotiable for long-term safety and mechanical reliability.
The fact that they are executing a massive, rigorous turnaround on a newly converted renewable diesel plant reveals a fundamental truth about their corporate mindset. To MPC, it doesn't matter if the raw input is heavy Venezuelan crude oil, Canadian tar, or agricultural soybean oil. It's all just molecules.
The operational playbook is identical. Run the hardware safely, run it reliably, optimize the chemistry, and squeeze every possible fraction of a cent out of the margin.
They are completely agnostic to the narrative. They are purely focused on the optimization of the physical process.
We have covered a massive amount of ground today. We started by examining the sheer financial gravity of a $12 billion profit engine that is aggressively cannibalizing its own share count to reward investors.
We dissected the physical chemistry of the global crude chessboard. We explored how billion-dollar investments in extreme metallurgy and hydrotreating technology allow them to chew through heavily discounted sour crude. We saw how their trading teams leverage macroeconomic distress, like a landlocked pipeline in Alberta or the influx of sanctioned barrels on the Gulf Coast, to structurally widen their profit margins.
We witnessed a ruthless game of survival in the walled garden of the West Coast. While competitors suffocate under the weight of toxic regulatory environments and shutter their gates, MPC is deploying surgical capital into their Los Angeles refinery, perfectly positioning themselves to capture the inelastic demand of a massive population center and the surging jet fuel requirements of the global aviation sector and the U.S. military.
And underlying all of this volatility, we mapped out the hidden midstream safety net. We saw how MPLX operates a toll road for 10% of the nation's natural gas, completely insulated from commodity crashes. We unpacked the geological reality of aging shale wells producing massive volumes of associated gas, perfectly timed to meet the insatiable baseload power demands of the artificial intelligence revolution, funneling billions in completely stable tax-advantaged distributions back to the parent company to fund the entire enterprise.
And finally, we witnessed the death of the mega refinery era. Under the guidance of a lean-minded CFO, MPC has embraced unyielding capital discipline, spending surgically to debottleneck specific constraints and target 25% returns, all while navigating complex labor dynamics with rolling extensions to ensure the golden goose continues to operate flawlessly.
Why does all of this matter to you? Because this hyper-optimized supply chain is the invisible scaffolding of modern life. When you board a commercial flight, when you receive a package transported via diesel truck, or when you ask a generative AI model a complex question that requires a hyperscale data center to pull massive baseload power from the grid, you are directly interacting with the physical reality of these molecules. The fuel powering your life is the end result of a geopolitical chess match involving Canadian geology, Venezuelan sanctions, extreme chemical engineering, and seasonal vapor pressure algorithms, all orchestrated by a commercial team fighting to capture 114% of a theoretical limit.
We started by assuming a massive industrial facility operated on a simple, predictable equation. We discovered that the equation is infinitely more chaotic, yet masterfully controlled. MPC has built an invincible, self-funding cash machine that doesn't just survive global chaos, it actively feeds on it.
But as we close this deep dive, I want to leave you with a profound question about the future. We have seen how brilliant, how ruthlessly efficient this optimization is, but it is fundamentally an optimization of the existing legacy system. In a world that is structurally pivoting toward electrification, grappling with the physical limits of atmospheric carbon, and navigating volatile geopolitical fragmentation, how long can a strategy based entirely on optimizing the old machine hold out before the fundamental rules of the game change entirely? Can you surgically debottleneck a legacy system forever? Or eventually, does the walled garden close in completely?
Thank you for taking this deep dive with us. You are now armed with a totally new perspective on the hidden mechanics of the global energy landscape.